evening, everyone. Welcome to our UCI Alumni Workshop. My name is Jason Maida. It's great to be with all of you this wonderful Thursday evening. Hope you're doing well. And I appreciate everyone taking some time to get connected with us for tonight's class. Tonight's class will be just about an hour. This is a class that we put on for UCI alum basically about every quarter. So we'll do 4 classes like this throughout the year. I think this is our second class. And if you enjoyed tonight's content, we'd love for you to share this information with friends, family, maybe some coworkers that are thinking about home buying. A lot of great things to talk about tonight, especially in today's housing market. Everybody has a lot of questions out there, so hopefully we'll be able to address all those. Speaking of questions, this is a very interactive video call, so we encourage you to ask questions as we go through tonight's content. You can either use the chat feature in Zoom or you can use the Q&A, and I'll answer those questions live on air, and hopefully we'll give you some good answers that'll help you on this journey towards homeownership. As we get into tonight's class, love to be able to kind of know where everybody's joining us from. I know we're probably mostly in the Orange County market, but if you can, drop in the chat where you're joining us from. It's always interesting to hear where our guests are joining us from, because especially as we talk about housing market data, love to kind of know where you're at, because all markets are a little bit different, and we'll love to know kind of where you're located or maybe where you're thinking about buying. So thanks for those that are putting their information in the chat. I appreciate that. Very cool. Okay, a little Bay Area, Inland Empire, Coachella, Diamond Bar. Okay, awesome. Awesome. Very cool. All right, so primarily California, so great. Well, wherever you're at in California, hopefully it's good temperatures. I know I'm in Northern California today, and it's a bit hot here. So hopefully we'll get some cooler temperatures at some point. Well, just a little bit about our organization. So we're called American Pacific Mortgage. We've been a partner with UCI alumni for going on about 5-6 years. I've got a chance to teach multiple classes to over probably 800, 1,000 students with UCI as part of our workshop platform. We also do some classes for some of the international business school classes as well too. So we really try to be invested in what's going on with the UCI community. And we're here to help support you on this path towards homeownership by providing educational tools like our class. So American Pacific Mortgage is one of the top 10 lenders in the country, and I happen to run a branch here that specializes in university partnerships. A little bit about me. I facilitate obviously classes like this. I've been in lending for over 20 years, and I specialize in first-time buyer programs. So being that this is going to be one of the largest financial decisions you decide to make in your upcoming years, we want to make sure that you have all the tools and resources to help you on this path. All right, so some of those tools will be part of our agenda today. We're going to spend some time looking at the housing market in just a bit. We'll talk a little bit about interest rates. That's a really good topic to key in on tonight, because we had some movement in today's market. We're also going to do a budgeting exercise on looking at renting versus buying. We also want to spend some time looking at credit, student loans, how they can impact qualifying. We'll talk about loan programs, documentation from an income and asset perspective that we should probably start gathering if we're thinking about looking at our options. And then we'll talk about first-time buyer assistance programs, and then spend just a bit of time in the latter part of tonight's class looking at the buying process. So if I'm thinking about buying, I've attended tonight's class, and I'm really kind of curious about what my potential buying power looks like, and if I want to get on that path. We're going to walk you through the steps to go from class to actually like getting pre-approved to hopefully getting a home that works for you. All right, so that's kind of tonight's class. Again, this is a very interactive session. I encourage you to ask questions using either the Q&A or chat function in Zoom. And let's go ahead and launch in now. And when we think about buying a home, like I mentioned earlier, it's probably going to be one of the biggest financial decisions you make in the upcoming years. And I think as you're considering home ownership, you want to consider all the benefits that come along with owning a home. In today's housing market, where things are a lot more expensive, no matter where you're at in California, the cost is significant, right? It's going to look a lot different than renting. But I think it's important for you to understand the benefits that come along with owning a home. What we were able to do, like controlling affordability to it a certain extent in buying a home, so we can kind of control with the stability of our house payment. This is an asset that hopefully will gain equity over time. Equity is created based upon the market value versus what your balance looks like on that particular mortgage for that home. The difference between those two numbers is home equity. And One of the great things about real estate, it can create generational wealth for our clients, and that's really exciting. And finally, there's some really good tax benefits that come along with owning a home. So when we compare renting versus buying, we always like to kind of launch into our class looking at a budgeting exercise to really kind of frame up the true differences between renting and owning a home. So we're going to jump into our budgeting tool right now just to kind of do a quick analysis of what it could look like for me to decide to buy a home versus maybe continue to stay on that path of renting. We've kind of pre-populated some of the numbers on our calculator screen that you can see here just for time purposes in tonight's class. But I did want to tell everyone that all of our presentation material, we're going to send back out to you via email tomorrow. We're actually recording this class as well. We'll have that up on our YouTube channel. You'll get some more information on how to access our YouTube channel a little bit later on. So we'd encourage you to try to take some notes tonight, but of course, we'll have this all recorded for you to check out tomorrow if you so like to. All right, so let's look at the budgeting calculator. And like I said, we've kind of pre-filled this in a little bit. So the way this tool works is we're going to first input some of our rental information. So if we had a client that's spending $3,000 a month in rent, let's say they have renter's insurance at $15 a month, they maybe have an expectation that their rent's going to go up 5% per year. So that's plugged in the calculator. And then if we look on the next tab below, there's the home purchase tab. And so if we open this up, let's assume that we're going to look at maybe a $700,000 place. We have a minimum down payment of 3%. You're going to learn more about down payment options in our program segment. And then we look at what the property taxes are going to be on that house. Generally, from a lending perspective, we use a baseline of 1.25% of the total sales price for calculating taxes. We have homeowners insurance, and then we have maintenance costs on our home. We also would want to factor in HOA fees if we're going to consider a condo or maybe a townhouse. So HOA stands for Homeowners Association dues. And then under our loan information tab, we assume a 30-year fixed mortgage. We plug in a market interest rate, let's say around 6.75. We have origination costs. So those are the costs that lenders are going to have in basically processing your financing. Now, one of the great benefits we have with our partnership with UCI alumni is that we reduce our origination costs to help give you a competitive option for you in home ownership. And then discount points are where you as a buyer can decide to pay additional costs out of pocket to bring down that interest rate. In today's market, it may not always make sense to do that because there's a break-even mark of about 3 to 4 years when you pay points. And for most buyers entering today's housing market, they're probably going to be looking to refinance down the road in a year or two. So paying big investments and discount points doesn't necessarily make a lot of sense. And then we have other settlement services like title, escrow fees. When you buy a home, there might be transfer taxes for the area that you're going to be purchasing in. So all those things would also be under those assumptions. Now, the last section will be other assumptions like the appreciation rate of my home. So we're assuming that's going to go up maybe 4% on an annualized basis. How long am I going to be in this house? So this projection here is saying 7 years renting versus 7 years buying. We're looking at selling costs of the home. We're factoring in the state and federal taxes, and then a savings rate at, let's say, 3 to 4%. So this calculator comes back and, you can see kind of we've already pre-filled this. But you can see that from a buying perspective, we're saving ourselves about $63,000 a year by just choosing to buy versus rent. Now, at the same time, we want to look at our monthly budget because our budget on a rental side of things is $3,000 a month. Whereas owning, it's double, right? So when we're thinking about our budget, yes, we're going to be going up from a homeownership perspective, but at the same time, we do want to factor all those things we kind of led into with tonight's class, which is, equity appreciation, potential tax benefits that come along with a home, generational wealth creation through homeownership. And we understand too, at the same time, it may not be the right entry point for some buyers to get in today's market because of the cost of housing. At the same time, in the next couple of years, I think there will be some opportunity for buyers to be able to maybe free up that budget a little bit as refinancing opportunities present itself. Now, what refinancing means is refinancing, just like you can do with even a car loan, is you're taking, because market rates might be lower at some point in time, you're basically refinancing your existing balance to that market rate in exchange for obviously a lower monthly payment from a mortgage standpoint. All right, so that's pretty common in home ownership. It doesn't always make sense to do refinancing. We generally want to see clients at least saving 1% in mortgage interest rate to have that really make a lot of sense, because refinancing doesn't necessarily, there's a cost to it. There's not like a free option for buyers. All right. So that's our rent versus buying calculator. I think that's a great way to launch into tonight's class. And I think the next thing we got to spend some time talking about is the housing market. I know all of us are in different parts of California, whether it's Northern or Central or Southern California, but the markets look very similar, I think, and they have all kind of very similar challenges. Right now, we just don't have enough inventory on today's market. So whether it's in the new home sales space or the resale space, there's just not a lot of supply to support the buyer demand. We just put out a video on our Instagram today, and I talked a little bit about what's going on in the housing market, because for whatever reason, now we're starting to see summer buying pick up. And usually buying starts really in the spring and then really starts to kind of get going in like May, June, because everybody wants to get kind of situated in a community. Maybe it's a family that's trying to get into a certain school district. But for whatever reason, right now in July, now it's really started to pick things up. And I think the consumer is starting to realize that maybe interest rates aren't truly going to come down, and it kind of is what it is. And unless we enter today's market, we might be priced out. And I think there is some signs of that, and you look at, the housing market. This is kind of an LA snapshot, but you could even overlay this with Orange County, maybe change the median price, but this trajectory doesn't look a lot different. So you're seeing still a little uptick in prices. You're seeing homes on the market for about 35 days. That means from the date of offer, or from the time the house goes on market to the date offer, is about 35 days. That number will probably shrink at some point. And the question is going to be, where do home prices go? Now, as interest rates fluctuate, so do home prices. Generally, when you see interest rates start to go down, you'll see home prices pick up, because you're going to have more buyer demand with lower interest rate levels. Where prices go will be very interesting, because if we don't solve for inventory and we have a lower rate environment, that's going to create more buyer competitiveness. And I think that's part of probably why we're seeing more buyers get into today's market, because they want to have less competition. If we look at interest rates over the last 12 months, this kind of gives you a snapshot of what we've experienced. It's certainly very, I felt what this slide looks like, which is kind of like a roller coaster ride. We started with, just below 7 rates earlier this year, or in 2023 in August. Then we kind of peaked up to 8% in October, and then we tamed down the slope. Earlier this year in January, we were like in the 6.5 level, and then we've kind of come up a little bit. Right now, we're in about 4-month lows in interest rates, right around 6.6 to 6.7. Obviously, that's fueling a little bit of the buyer demand. I think, this interest rate environment is really not, kind of scaring buyers off at this point, because as I mentioned earlier, I think buyers are now realizing this is kind of the market right now, and we're probably not going to see things change up too significantly for a couple years. Now, the Federal Reserve has been controlling rates based upon what we're trying to get to from an inflationary goal. The goal of inflation is 2%. We're still above 2%, but today we had we call it the Consumer Price Index report. We had a reading that was below expectations. And so we actually saw inflation's basically go down a little bit today, which fueled a better interest rate environment. So rates improved by about 0.125%. Hopefully a good indication of more things to come, because as the Federal Reserve works towards a 2% inflation goal, our hope is that we'll at least see 2 interest rate cuts this year in 2024. Now, interest rates aren't the same for all buyers, so I think that's important to understand. There's different ingredients that go into an interest rate, like credit eligibility, like the type of product that I'm going to elect, how much my down payment is, how much do I decide to finance, do I elect to pay discount points to bring down my interest rate or not, and what kind of term of loan am I looking to do? Do I want a 30-year fixed loan? Do I want to do 20 years or 15 years? For most of our first-time buyers, it's more than likely going to be a 30-year fixed product, because that gives us the most manageable payment scenario. But as we meet with clients throughout the day, we're going to basically design some options that work best for you. We call that putting together a home buying plan, so we can hit all your goals and objectives in home ownership. And that's what I do basically on a daily basis, is meet with clients for 20 to 30 minutes over video and just kind of design plans for them. Now, as we look at product options, interest rate scenarios, and really figure out that plan for homeownership, credit plays a major role for our buyers. From my perspective, there's usually two challenges for first-time buyers. It could be centered around credit because maybe I'm a little bit overextended with debt, or maybe some past credit challenges, or I just haven't saved up enough money for homeownership. Well, we'll talk about savings a little bit later in tonight's class, but let's spend some time looking at credit. And I think it's first important to understand that there's different models to credit scoring. So many of you in tonight's class have different monitoring tools like Credit Karma, or maybe you use your Chase app to see what your credit score is. Those are all great tools, but they do use a credit card model. The three models are credit card, auto, and then a mortgage model. So I want to spend some time looking at the score calculation from a mortgage perspective, because obviously that relates to what we're going to talk about tonight. So 15% of the credit score model is going to be how long have I had credit. So the more mature my credit file is, the better my credit score can be. 20% is going to be how much new credit am I trying to open? If I open a new account, am I having hard inquiries that are hitting my credit score? That's the 20% makeup of the weighting for the credit score. Now, one of the things I think it's important to understand that in starting our process for homeownership with us, we only start with a soft credit score. And the reason why we do that is because soft scores don't impact your credit score as hard inquiries do. And so you really want to limit the number of hard inquiries. And with soft inquiries, especially for our first-time buyers, we never know when they're going to purchase, right? It could be this year goal, it could be a next year goal. So we don't want to impact their scores and at the same time trying to figure out what home buying options they have. 30% is going to be credit utilization. So we're kind of looking more specifically at revolving credit. So if we're looking at, let's say my total credit card limits are at $10,000 and I have $5,000 in balances, I'm at 50% utilization of credit. The rule of thumb, if we're trying to really optimize your credit score, you want to be at 10% utilization or less. And if you're running a little bit higher, let's say 70 or 80% utilization, I think our first one-step goal would be to get below 50% utilization and then work towards that 10% threshold. One of the things I want to share with our group tonight about managing utilization is how you look at your credit card billing. So there's two dates on your billing statement. There's the credit card billing statement date. There's also the due date, right? The due date is when you can pay your bill and all that stuff, but the cycle date or billing statement date is the date when the credit card issuer closes all the activity for that cycle and then reports all the information out to the credit bureaus. What I would challenge you to do is if you can try to pay down or pay off your credit card before the end of the billing cycle date, what you're going to be able to do is to get a better reading on your credit report, meaning that balance is going to show lower when they report the data out to the agencies. In turn, you're going to have lower utilization, hopefully a higher credit score, because often clients will be maybe paying on their due date, which is nothing wrong with that, but it falls after the billing cycle date. And so you don't get the kind of the uptick in your credit score. Now, the last weighting is payment history. That's how I paid my bills. If I've had some past delinquencies, they'll be rated as 30-day lates, 60-day lates, and then 90-plus delinquencies. The more severe the late payment is, obviously, the bigger the impact to the credit score. When we're looking at past challenges in credit or maybe hard inquiries on your credit, the Bureau is going to really pick up the most recent 1 to 2 years of that activity. Now, every loan product has a minimum credit score, and we have some of those noted on screen here. But for each product, there's a minimum entry point for credit score. Major events like bankruptcies or like written off accounts, we call those charge-offs, those are going to have a bigger impact to your score than, let's say, a 30-day late to your score. But the turnaround time in terms of how long it's going to impact your score will be certainly in the most recent 12 to 24 months from the event. Account closure is something that we should talk through really quick. So what we're talking about there is if you decide to close out an account like a revolving account, that could have a negative impact to your score. And the reason for that is when you close out an account, you actually pull away all the history from that account from the credit bureaus. So if you've had an account for 10 years and you close out that credit card, that could negatively impact your score. And also it lowers the amount of available credit that you have too, that can also impact your score. Now, from a lending perspective, we look at all three agency credit reports. That would be TransUnion, Experian, and Equifax, but we take the middle credit score of all three of those. So if my top score is 760, my middle score is 740, and let's say my lowest score is 720, we're going to use 740 for the credit score. Now, if I'm going to apply with my partner and my partner's at 740, 720, and 700, the 720 would be the lowest credit score between the two of us. So that would be the score that we would use for a qualifying from a qualifying perspective. So that would be, around interest rate, around mortgage insurance that we'll talk about a little bit in just a bit, as well as the product selection. And as we kind of transition out of credit, I want to kind of share with you this matrix that can help kind of guide you with like negative items on your credit report in terms of how long they'll stay with you. To my point earlier, they'll usually be with you for the most recent 12 to 24 months, but this is how long the impression will be on the credit report. All right, before we jump into student loans, I just want to kind of just check in with everybody. Any questions so far about any of the content? Maybe questions around credit or anything I can help answer? Okay. All right. So feel free to use the Q&A function or chat function in Zoom, and I'll definitely answer those questions for you on air. Let's talk a little bit about student loans. And so with student loans, those are something that we should, kind of keep in mind when it comes to qualifying for a mortgage, whether we're in school or not. If there's an outstanding balance for student loans, we do have to count those into the qualifying. So for example, as you can see on screen, let's say I'm a client, I have $75,000 in student loan debt. If I'm not in an income-based repayment like I have on screen, then we have to, by default, count 1% of the outstanding balances for a conventional loan as your monthly payment, which would be $750. Or on an FHA loan, it's 0.5% of your outstanding balances for the monthly payment, which in that case would be $375. Ideally, if our clients have an income-based repayment amount, that's generally going to be the lower payment that we can use for qualifying. So regardless if you're in deferment or if you're in forbearance, there still has to be a minimum debt that gets counted into student loans. Those are, it's just the reality of, working with our clients that we're gonna have that conversation. I would not let student loans hold you back from learning more about home ownership, because as we kind of get a chance to look at what that debt looks like for you, we'll help give you some navigational tools to help you through that. Okay, we got that. Okay, so let me put the chat. Okay, cool. So we got, sorry, I just want to make sure I get caught up on questions. Okay, looks like somebody put one of the MyHome products in. Okay, cool. All right, very good. So let's kind of dive in and now kind of, or I should, let's say, move along. Let's talk a little bit about loan programs. And so as we look at loan programs, there's a plethora of programs, but I want to kind of spotlight just a few for tonight's class. And we're going to look first at the conventional loan product, which is, when you think about conventional loans, they're going to be around Fannie Mae, Freddie Mac type products. I think somebody put a Freddie Mac tool in the chat here, which we'll talk about Freddie Mac first time buyer resources later on. But with those different products, Fannie Mae and Freddie Mac houses about 70% of all originations across the country. For a conventional loan up to the conforming loan limit amount, the minimum down payment is 3%. For our high cost of living areas like Orange County, LA County, Bay Area markets, when we exceed the conforming loan limit, the minimum down payment jumps from 3% to 5%, up to a maximum loan amount of 1.149825. So that's called the high balance loan limit. So that minimum down payment jumps from 3% to 5%. Now, with the conventional product, it does have a minimum credit score of 620. And if you put less than 20% down to purchase your home, there's a thing called mortgage insurance. And we're going to learn a little bit about mortgage insurance or private mortgage insurance in just a bit during our mortgage insurance segment. But the conventional loan product is going to have different tiers of mortgage insurance based upon credit score, down payment, and how much I decide to finance. The next product is a government insured loan. So a little bit different than private mortgage insurance. It's called FHA, which stands for the Federal Housing Administration. Minimum down payment of 3.5%. Now, different than the conventional product, we can still go beyond the 765 loan amount, and that down payment remains at 3.5%. The FHA loan has a minimum credit score usually at 580. A lot more flexibility from a guidelines perspective. So if I've had some past challenges, the FHA product will allow a little bit more flexibility. So let's say I missed a credit card payment in December of 2023. FHA would be okay with that, but that might be a little bit more challenging if I was looking at more of a conventional loan product. Now, FHA is a government insured product, so you're going to learn a little bit more about what that insurance looks like in the mortgage insurance segment in just a couple minutes. The VA product is for our veterans that have served and have eligibility for the VA home loan. It's a 0 down payment option. There really is no maximum loan amount with the VA product, but what I've seen, at a 0 down payment amount, $1 million, $2 million on the VA product. What's different with the VA home loan to support the veteran? There is no mortgage insurance on a VA loan, even if you're putting less than 20% down. The minimum credit score on the VA home loan is a 620 credit score. With a VA loan, for those that do not have exemption for the funding fee, VA charges a funding fee for first-time users, which is generally 2.3%, give or take, of the total loan amount on the VA loan product that gets financed in for the veteran. The next two products we're going to cover really quickly, but it's the USDA product, which allows buyers to purchase in more rural areas. It's a 0 down payment option up to the maximum loan amount you can see on screen. There's two big qualifiers with USDA. One is there's maximum income limits by household size. Two is it's geographically restricted. So, you have to be in a USDA deemed rural area. So let's say I want to buy a home in Joshua Tree, right? Well, that would be USDA area that could qualify. What tends to be a little bit of a challenge on the USDA product is just the income limits. So that's something if you're interested in, certainly something we can talk through. It is also compatible with some of our first-time buyer programs like the VA product is in FHA and conventional loans. And then finally, the jumbo loan product are for clients that need to purchase a little bit more than what can be supported by conventional FHA or any other government insured products. The jumbo loan generally has a minimum down payment of 10 to 15% of the sales price. So a little higher asset requirement, but it also has a reserve requirement. What reserves mean is that additional funds that I have available to me after I've contributed my down payment, my closing costs. Usually the minimum reserve requirement is 12 months of my monthly payment. So let's say my monthly payment is $8,000 a month and I have a 12-month reserve requirement. That means I need about $96,000 in additional assets after I've contributed those other requirements of down payment and closing costs. All right, let's talk about private mortgage insurance, or PMI. I'm going to do a little bit of a side-by-side comparison with you on conventional versus FHA. You've heard me kind of talk a little bit about the conventional PMI, but let's kind of dive into it a little bit closer. There's different options on the conventional product for PMI in terms of how you pay that particular insurance. There's monthly mortgage insurance options, which are probably about 95% of most consumers are going to do that. There's split mortgage insurance where I pay some of it up front, some of it on a monthly basis. There's single premium insurance where I'm basically buying out the mortgage insurance as part of my closing costs or my cash out of pocket. Then there's lender paid mortgage insurance. And with that, I'm basically electing a higher than market interest rate in order to buy out my mortgage insurance. Not selected a lot, especially in today's market where interest rates are already as high as they are. But PMI is a little bit different than what you'll find on Zillow and Redfin when you do some of their calculators, because there's different ingredients that go into PMI. One is credit scores. The other thing is down payment and how much I decide to finance. So the more I can put down, the higher my credit score, the less I finance, the cheaper my mortgage insurance is going to be. So when you're doing some searches on Zillow and Redfin, those calculators might not be totally accurate. We'd encourage you to use our mobile device, or mobile calculator, I should say. That has a lot of great features on it to give you a little bit more of an accurate reading on payment. Now, with conventional loans, it does have a cancellation option on mortgage insurance, which is a really important feature, so that when you achieve at least 2 years in your loan and 20 to 22% equity, you can apply to have mortgage insurance canceled. So if we dive in a little deeper and look at a conventional PMI example we have on the bottom of the screen, if we finance, let's say $700,000, I have a 740 credit score, and I'm deciding to put down 3%, my mortgage insurance is just over $200 a month, right? So not as expensive as you might think. And then if we can increase that down payment or our credit score goes higher, that monthly PMI can even go lower. Now, if we compare that to the FHA product, FHA has two forms of mortgage insurance payment. It has monthly mortgage insurance, which is usually 0.55% of my loan amount. It also has upfront mortgage insurance, which is 1.75% of my loan amount. So that's pretty significant from an expense perspective. If you've already started looking at rates online, you might be, maybe looked at you did a little search on what mortgage rates look like. What you will find sometimes is FHA mortgage rates look a lot lower than conventional rates. primarily because the expense structure looks a lot different, and you're seeing it right here. So there's monthly mortgage insurance and upfront mortgage insurance on FHA. So while that rate might be, say, 0.5% lower on FHA, when you kind of add it up with the expenses, it's a lot more expensive from an FHA perspective. Now, FHA mortgage insurance can only be canceled through a refinance by maybe refinancing into a conventional product. Otherwise, MI is in place for the full 30 years. And if we look at another payment option here on FHA, we take that same $700,000 loan amount, we add on the upfront mortgage insurance, which in this case would be $12,250. So that gets stacked on top of our amount financed. And then we have monthly mortgage insurance, which is $320 per month. So, doing the side-by-side comparison, clearly, I mean, the expenses are a little higher on FHA, but all that being said, I think it's really important for us to understand in class is that just because the expenses are a little higher on FHA may not necessarily be the wrong product for a buyer. So, FHA is going to have different guidelines than conventional, so it allows that lower credit score requirement, a little bit more lenient in terms of last or late payments on accounts. So FHA will give us a little bit more flexibility, but as we meet with clients, we're just going to try to figure out what's the right option for you based upon your own home buying goals and, of course, eligibility by product. All right, let me just I had a couple questions pop in the chat, so I want to make sure I get those. Oh, we got, okay, so Ken answer that question for us. Okay. Okay, so we got that. We're good there. All right, thanks for your question. I think Ken was able to answer that for you. Let's talk really quickly about some of the documents that are needed in the home buying process. I think it's just important to understand that. So if you're thinking about getting on the path, we'd love to kind of just share with you what things we need. So generally includes the last couple of years of financials like taxes, W-2s, bank statements for the last 60 days, and pay stubs for the last 30 to 60 days. And as we talk about documentation, I like to kind of spend some time talking a little bit about income for your qualifying, because there's a lot of kind of misrepresentation of what income is needed for qualifying in a mortgage. So let me kind of walk you through some different scenarios to help you kind of better understand this. So in financing, there is a rule that we need to have at least 2 years work history and or at least educational history. And what that means is that, and let me just give you an example. Let's say, for example, I graduated from UCI in the fall and I started my new job January 1. Well, many people think that because I haven't been on my job 2 years, I don't qualify for a mortgage, but that's not necessarily the case. So if I can show my educational history with UCI of the last 4 years, let's say, and now I'm starting my job January 1, I've met the educational / work history requirement of 2 years. Okay. So that allows you to get into home ownership a little bit quicker. Now, another thing that comes up sometimes is buyers thinking that they have to be on their job 2 years now in order to qualify for a mortgage. So you can qualify with less than 2 years work or on the job history. In fact, some of our clients that are looking to transition to a new job can get qualified simply off an offer letter for their new employment. Now, where the 2-year rule is a little bit more strict, if you will, is that when we look at maybe a client that's self-employed, right? We do have to show 2 years generally of taxes for self-employed clients. That 2-year rule also holds true if I have multiple sources of income. Like, let's say I have 2 jobs, like maybe I'm in the healthcare industry and I work for one clinic for 30 hours a week, another clinic for 30 hours a week. In that case, I do have to verify that I've been on both jobs simultaneously for the last 2 years. If I have maybe a side job, like maybe I work for Lyft or Uber on the side, but I have my 40-hour work week job, if I do want to consider both sources of income from a qualifying perspective, then I have to make sure that I've been on both jobs for 2 years. Another thing that comes up when I'm working with clients is kind of like additional sources of income. So for example, if I'm going to apply in just my name for my mortgage, but my partner contributes to our household expenses because they have income, unless my partner is going to join the application, then that income generally is not considered from a qualifying perspective. If I've been renting out maybe a room in my place, my current rental, most products will not let us take that as a go forward income stream. So meaning I can't use that rental income for my next home purchase. Some products will allow you to prospectively use rental income on multiple unit properties, but if you're buying a 1-unit property, you can't use rental income from your current place. All right. Okay, let me answer this. So a question was in the chat just about us recording tonight's class. So yes, we are recording tonight's class. So we'll have that up on our YouTube channel. I think Ken's responded to you on that. So thank you for that. And yes, this will be recorded and on our channel tomorrow. So let's stay with income. I want to kind of just spend some time talking about one of the qualifying metrics that we use as lenders. It's called debt to income ratio. It's a pretty simple calculation. It's just your gross monthly income versus your monthly expenses like personal loans, credit cards, the new mortgage payment. All those things get factored in as expenses versus your gross monthly income. It is a pre-tax number that we look at. So when we look at that calculation, we take into consideration the principal and interest of your mortgage, the property taxes, the homeowner's insurance for the new house. If I'm putting less than 20% down, let's say for a conventional loan, private mortgage insurance, if I'm deciding to buy a condo or a townhouse, homeowners association dues, and then we also add in our other debts. And then we just compare that to our gross monthly income. So in this example we have on screen, we have a client that has $3,000 in expenses, $8,500 in income, and we come out with a debt to income ratio of 35.29%. Now, a lot of clients will ask me, well, where should that debt to income ratio be? And I think the sweet spot or comfort zone that I see for most first-time buyers is around 33 to 36% debt to income ratio. Now, can you go higher in debt to income ratio? Yes. I mean, most products will allow you to go to 45 to 50%. But I think it's important as first-time buyers to really understand that, you know, even though we can qualify to a higher amount, we really want to dive in a little bit deeper and look at affordability. So one of the conversations we have during your consultation is figuring out like what's the right number for us to be at from an affordability perspective, because we want homeownership to be affordable for you and sustainable over time. So if something happens financially, that you're still going to be able to hopefully afford your home on an ongoing basis. All right, so the last component of kind of what I would call building a home buying plan is to think about savings and assets that we ultimately need to purchase our home. So we want to kind of look at some different resources that are available to you in home ownership, but also kind of some of the documentation needed. So when we think about down payment funds, we're looking at documentation in our maybe in our checking, savings accounts, other retirement accounts or investment accounts. We'd always encourage you to talk to your tax or your financial advisor before you get into those accounts, because we don't want to create any tax event for yourself or lose any market appreciation there. Gift funds can also be potentially used for qualifying, and that's where a family member is helping contributing towards your down payment and or closing costs. Most assets need to be seasoned for at least 60 days in your account. Now, gift funds do not need that seasoning requirement, but any asset beyond that would generally need a 60-day requirement. We have a quick note here about cryptocurrency that comes up quite a bit. Cryptocurrency is not recognized as a valid asset. The only possible workaround in that case is you would have to sell the cryptocurrency, and then those funds would have to season in your account for 60 days for them to be used as a viable asset. Now, most of our buyers are kind of building momentum on this path towards home ownership. And so in this segment of our class, we like to talk a little bit about how we get to a savings, a certain savings level, right? So we talk about our savings plans with clients. And I think, as you're getting that momentum towards home ownership, I want to give you just a quick little kind of approach to take, or maybe a discipline that you can create in savings for yourself. And it's really simple. So, if you were currently spending, let's say, $2,000 a month in rent, but after meeting with us for your home buying plan, you kind of figure out that I think I could maybe pay like $3,500 a month from a mortgage perspective, right? So that right there is about a $1,500 variance between what I'm paying in rent versus what I think I can pay in a mortgage. But maybe I'm not quite there from a savings perspective. So what I would encourage that client to do is to start paying yourself at a $3,500 a month mortgage payment, but you're paying $2,000 to your rent, of course, but you're taking that additional overage of $1,500, and that's going right to your savings account on a monthly basis. So two things are happening there. One is you're creating the discipline of paying a mortgage payment at $3,500, so it's not such a big sticker shock when we buy our house. But then we see that savings account grow over time. 6 months from now, we're at what, $9,000 in balance. By the end of the year, maybe we're at $18,000, not including any type of high yield interest account. So that's an opportunity for us to grow from a savings perspective and take a really simple approach in helping grow our asset base. All right. Let me just quick quick check on questions. We had one question that came in. So, which is what happens if your main source of income or employment has increased significantly over the past 2 years due to raises? How does this factor into calculating the debt to income ratio for pre-approval? So the debt to income ratio is taking a snapshot of today's income versus expenses. Now, for some of us that have variable income like commission or bonuses or overtime, those will get averaged over 2 years. But if I just got a raise, let's say on July 10th or 11th, that snapshot of how I'm going to calculate the debt to income ratio is based upon where I'm currently at from an income perspective. All right. Thanks for the question. Let's spend some time looking at first-time homebuyer programs, and we're going to talk specifically about programs available to you in purchasing in the state of California. So we're fortunate enough to be the #1 provider of the CalHFA loan programs in the state of California. So CalHFA stands for the California Housing Finance Agency. It's designed to support low to moderate income households in home ownership. For those of you that may be kind of watching first-time buyer programs, you may have heard about the Dream for All program. It got a lot of spotlight. Probably saw it on some of the news outlets. A lot of people doing some posts online and social channels. That program is currently activated with buyers shopping using vouchers that they received from a lottery. And that program may be back again in 2025. It's just kind of an unknown right now. But CalHFA does have a lot of great programs that are available still that are activated in today's market. And one of those programs is called the MyHome Assistance Program. And that basically provides up to 3% of your sales price in assistance for a conventional loan, 3.5% for an FHA loan. And the way that works is the state's providing you a low interest rate loan at a 1% interest, simple interest rate loan that does not have any repayment until you either sell the home or if you decide to refinance in the future. So, we talked a little bit about our product minimum down payments with products. That My Home Assistance Program would help solve for the minimum down payment. And there's also closing cost assistance programs like the ZIP Assistance Program that will provide up to 2 to 3% of your loan amount at a 0 interest rate to help lower that out-of-pocket expense. The challenge with ZIP Assistance right now is today's market's still a bit expensive from an interest rate perspective. So adding the ZIP Assistance Program into home buying plans for clients can really elevate that first mortgage rate. So right now, our recommendation is probably just to lean into just the My Home Assistance Program to help bring down that overall cash out of pocket. There's two big benefits with the CalHFA Assistance Program. One is interest rates tend to be a bit lower than market rates. So today's rates on the 30-year fixed mortgage was 6.625. And then also getting that the support of the assistance of 3% of the purchase price at a 1% interest. So let's look at an example really quick. Let's say we purchased for $700,000. The minimum down payment, as we learned earlier, is 3% of that purchase price. And then when we purchase the home, we do have closing costs, which will generally be 2 to 3% of your sales price. So if I was going to purchase traditionally without first-time buyer assistance, I'll probably need about $35,000 to $42,000. Now, if I incorporate a My Home Assistance Program, now I have $21,000 that could be used as a reduction in my total out-of-pocket expense. And then maybe that becomes a little bit more manageable or attainable for us in home ownership. And then, of course, if ZIP Assistance made a little bit more sense for us, we could use that to lower our out-of-pocket expense even more. Because as I mentioned earlier, there's two big challenges for homeownership. There's the credit side of things that we talked about earlier, but it's also just being in a position from a savings perspective. And an assistance program like CalHFA can help maybe make homeownership more of a near-term goal versus a long-term goal for you. Now, there are eligibility requirements with CalHFA. There is a minimum credit score of 640 for the FHA product, 680 for the conventional side of things. And if you're considered low-income housing on the conventional loan, it's a minimum credit score of 660. Debt to income ratio of 45 to 50%. And the income limits for the program are generally about 150% of the median income for your particular county. Now, one of the nice features of CalHFA is the income is based upon those that apply for the loan, not the total household income like other products. And why that's important is, let's say, for example, I'm going to buy in LA County. Well, LA County's income limits are $196,000. If I earn $150,000 and let's say my spouse earns $100,000, well, combined, we're over the income limits. However, if I'm going to apply in just my name, I would be within the income limits and still be eligible for the first-time buyer program. Now, a first-time buyer is someone that hasn't owned in the last 3 years. So I may have sold a home back in 2015. now I could still be eligible as a first-time buyer. Now, these are eligible products for single-family homes, townhouses, condos, new construction homes, even manufactured homes can be potentially eligible, but it does have to be on land that you own if you're going with the manufactured home. I know we have some of us that are in Northern California, but these are the income limits for Southern California counties. So you can see they're pretty lenient relative to most first-time buyer programs. Most first-time buyer programs will be at 80% of the median income. So this allows it to be a more inclusive program for many of our first-time buyers across California. All right. So that was our first-time buyer program. We're going to now dive into the buying process. So, as we're getting towards the latter part of tonight's class, and you're thinking about maybe putting together a home buying plan, I want you to be able to kind of understand, like, what's the process look like for me as a first-time home buyer. And step one is going to be your pre-approval. Now, the pre-approval comes out of the consultation that we do. So we meet with every client for about a 30-minute video session to design that home buying plan. And then the output of that session will be to hopefully be pre-approved. Now, what a pre-approval is, it's a certificate that you can provide to a seller or selling agent that says, I'm qualified, and here's the details of my financing. That pre-approval is usually good for 60 days, but we can always recertify it at any time. So you don't have to feel pressure to go out and buy a home right away. Most of our clients take maybe 3 to 6 months or even longer to go find a home. And that 3 to 6 months is really usually in the house hunting phase, which is step 2 in the process. So it usually starts online, and then it'll move to kind of in-person showings once we find a home that we really like. Maybe you're walking around the neighborhood and there's an open house and you pop in to check it out. That's all part of the house hunting phase. Now, once you eventually find a home that you like and you want to submit an offer, if that offer gets accepted, then we move to step 3. And step 3 is called entering escrow. So that means you have an agreement with the seller, and that process from the acceptance of offer to when you get your keys generally is 30 days. Now, it can be as short as 14 days, 21 days. We have what we call as our quick close program, allows us to condense that closing time all the way down to 14 days, because it is still very competitive in today's California markets. And so we want to try to give our first-time buyers an extra edge in today's market, and having that shorter timeline can help with better success rates with accepted offers. Now, once that offer is accepted, you get a call from me and I say, hey, congratulations, Jason, you have an accepted offer. We walk you through the next steps in the process and schedule you for a follow-up consultation to review all the details of your financing. Now, as a buyer, you'll need to contribute what we call as an earnest money deposit. That usually happens in the first 2 to 3 days of your contract period. That deposit is usually 1 to 2% of your overall sales price. It does count towards your total out-of-pocket expense. And then as your lender, we're going to order the appraisal on the house. Your realtor is going to help order inspections on the house, because in your contract period, you have another timeline called the contingency period. And that's part of most contracts in California that allows you to do your homework on the house. It usually was within the first 14 to 17 days of the contract, allows you to get the house appraised, get your house inspected, and then get your loan approved. And why that's important is because your deposit that you've made early on in the process is protected during that contingency period. Step 4 is going to be the processing and the underwriting of the loan. That's all kind of the administrative tasks that we're doing behind the scenes. We're verifying employment. We're locking in your interest rate. We're going to verify assets for your home purchase, maybe doing some of the administrative work on your first-time buyer program. All that's happening at step 4. And then we move to step 5, which is into the underwriting phase of things. And that's where an underwriter approves your loan. And we have a series of events that happens after that. It also takes you to probably the end of your contingency period. So if your loan is approved, your inspections check out is good, and you get your appraisal back, then you can sign off on your contingencies. And what that sign off does is it tells the seller that you're ready to move to the final stages because you've done all your homework on the property. And at that point, we're going to deliver to you a final closing disclosure that ultimately gives you a 3-day cooling off period before you get to the final stage, which is called closing your loan. Closing your loan entails signing final documents with the public notary, delivering your final funds for the home purchase. And then as a lender, we deliver funds for your mortgage financing as well as assistance programs. All that money gets then reconciled by an escrow team, and then documents get recorded with whatever county that you're going to purchase in. Generally, they record a grant deed to transfer ownership to you, as well as a deed for your financing. And that kind of basically tells, hey, this is my repayment terms of my loan. And after all the confirmations come back a recording, then we get a chance to celebrate with you and make the most enjoyable call of the day, which is say, hey, guess what? You're a new homeowner. And it's a huge accomplishment. And so often does that starts with, those of you that attended classes and then go out and get pre-approved, find a house, get your keys. I mean, we get a chance to go through that journey together and then celebrate at the end. It's a big deal. And, again, that's going to be probably one of the biggest financial accomplishments that you have. And so we want to be there to celebrate with you. Well, as you're kind of, thinking more about home ownership, I want to kind of give you some tools to get started in the process whenever that time is right for you, whether it's, next week or next year. We love to be able to get connected with you to help build your own home buying plan. What it entails is doing a really simple online application. We only do a soft credit check with that application, so you don't have to worry about your score being impacted. You will be responsible for uploading some follow-up documents and then scheduling a video call with me. That's where I'll get a chance to help build your own home buying plan. Now, after tonight's class, you may have some follow-up questions. In fact, I know we have a question in the Q&A that we'll get to in a second. But if you have some questions after tonight's class, you can get connected with us by scheduling an introductory call. We'd love to be able to answer any scenario questions for you or just kind of give you some more insight as to what homeownership could look like. This is what a consultation looks like. It's a free service we provide, so it's not something that has any type of like monetary cost to it. We're going to talk about where you're going to buy, what programs might match best for you. We'll help kind of guide you from a credit perspective, talk about assistance programs. And like I said earlier, the output of that session will hopefully be to have you pre-approved to start that journey towards home ownership. This is our mobile app that's available for Android and Apple devices. Great way of starting the application process, but you can also do calculator features there. You can also get push notifications on kind of what's going on with your application through the process. Well, as we get to the end of tonight's class, I just want to, thank the UCI alumni for allowing us to continue to partner with them. And as I mentioned earlier, we get a chance to pass along a discount and origination cost for you as a member of the UCI alum. And as I also mentioned earlier, if you have friends, family, coworkers that might benefit from our educational tools, we'd love to have them, attend one of our free classes. We also have other partnerships across the country that you can see noted on our screen here that we're really proud of as well too. But we're passionate about providing educational value in home ownership across our communities that we serve. This is all my contact information. So if you've want to have a follow-up conversation after tonight's class, feel free to reach out to me or schedule a call. We'd love to be able to get connected with you. And on our socials like Instagram and our YouTube channel, we're trying to put out good, helpful first-time buyer content. We'd encourage you to follow us at JMeda Mortgage. We try to post there regularly with some good information and also just celebrations of homeownership. So we'd love for you to be able to follow us there and check out also what our clients are saying about us in some of our reviews online. All right. Well, we have a few minutes left in tonight's class, and I know I had some questions that popped in the Q&A, so I want to get to some of those for our audience, and I'll stay here as long as we need to, and then we'll get a chance to wrap up when we get to the top of the hour. So let's start with the first question is, which was how many centered around the Dream for All program. Do you know how many people were able to get the California Dream for All voucher for this year? So just to give you some numbers, so 18,000 people applied for the Dream for All voucher. I believe 1,700 were selected for the voucher, and not all of which are taking their voucher. So the way the California Dream for All program rolled out, the lottery registration ended on April 29th. The lottery results came out June 28th, I believe. And so we were either waitlisted, selected, or not selected. So there's some people on the wait list for the Dream for All. There's also people that receive vouchers, but there's some people that may return their vouchers because they've already bought or whatever the case is. So it's still kind of a fluid process, but Dream for All is right now in like week 2 right now since we've released the vouchers. All right. I think this question got answered already, so I think we're good there. Let me just make sure. Okay. Okay, and the question in the chat, I answer for the group. It says, do you give consultations for other locations other than Southern California? Absolutely. So we're a nationwide lender. So, we do consultations for people in Texas or Virginia, California, Arizona, wherever the case may be. So yeah, and everything is all of our video platform. So, in this day and age, as you guys know, most things are going to be done on video or chat features or by phone or email. So that's kind of how we do things. But we do have brick and mortar offices across the country, depending on what community you're in. Okay, a lot of good. Thank you for the thank you message. I appreciate that. Very cool. Any other questions from our group? I know we still have a few minutes left. I want to make sure I can answer any questions that come up. All right. I think we're good. I think we might get out of class a couple minutes early. Well, I know I'm probably right in front of your dinner time, so I do appreciate everybody staying tuned with the class. Hopefully you found this information helpful for you on your journey towards homeownership. And if that is one of your goals coming up, we love to be able to partner with you on that goal. Now, we'll have all this material out to you tomorrow morning. Again, please check out Jay Made a Mortgage on our YouTube channel. You'll be able to see all the recorded version, and we'd love to be able to get connected with you soon. Have a good night.